So this week had more ups and downs with the Middle East still driving everything, but there were a few developments that are worth noting. The ceasefire between the US and Iran got extended after Iran did not show up to talks in Pakistan earlier this week. And Trump said he extended it because Iran is fractured and really needs time to come up with a unified proposal. Doesn't exactly ring endorsement for progress, but markets did take it better than the alternative of bombings resuming. And the strait remains, I should say, effectively closed, and both sides are actually seizing each other's ships now, or at least we've seen that. And oil is sitting around $93 a barrel. The ceasefire is holding, at least in name, but like I said, ships are getting seized, which doesn't really feel like a ceasefire to me. The pattern this week was familiar. Any hint of progress sent bonds up, and any escalation brought them back down. Markets seem to kind of have accepted that this is going to drag on, and they seem to mostly be waiting it out. Good news is that as long as the ceasefire holds and there isn't a return to bombing, rates probably won't push back to the highs that we saw in March. But the bad news is we really need the strait actually open and for oil back near February levels before we're going to see real meaningful improvement anyways. And Kevin Warsh's confirmation hearing, that was a bright spot actually this week. He was really impressive and he seemed happy to share his personal investments, said he never would have agreed to take the role if Trump told him he had to cut rates. And he was really direct about his view that the Fed basically has relied too much on old data like we've talked about, and he wants to be more forward-looking and also communicate less publicly so that the Fed doesn't feel boxed in by their own statements. And he also wants to use some new tools. Tom Tillis is still planning to block the confirmation until that Department of Justice probe into the Fed's renovation project gets resolved. So Powell's term ending on May 15th likely means there's going to be an interim chair for a while. On the economic side, we got retail sales that came in stronger than expected, but a chunk of that was just higher gas prices, not real, economic strength or growth. And ADP weekly numbers have been ticking up a little bit, about 55,000 jobs per week through early April, and that's worth keeping an eye on, but it's still not really strong. And one big industry update, FHFA and HUD jointly announced that VantageScore 4.0 is now accepted by Fannie Mae, Freddie Mac, as well as FHA. And lenders can actually start using it immediately, but I don't know how quickly lenders actually will. VantageScore can factor in things like rent and utility payment history, which means some borrowers who couldn't qualify under the FICO models might now have the ability to buy. And overall, I think it'll be a good change for both clients and lenders. There was a stat worth sharing with clients who might think renting and investing is smarter than buying. A $40,000 down payment on a $400,000 home at 3% appreciation generates about $12,000 in gains. That's a 30% return on that investment. The same $40,000 in stocks at a 10% return is $4,000. And you still have to pay rent. So 2/3 of the average American's net worth comes from home equity, and homeowners have 44 times the net worth of renters on average. Next week, we're going to get home price appreciation, the Fed meeting, PCE, as well as GDP. So I'll see you next Friday to talk about it.